This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 160 was recorded on March 28, 2019. I'm Eric Townsend. One River Asset Management CIO Eric Peters joins me as this week's feature interview guest. We'll discuss everything from the stock market to the bond market to the rise of populism and U.S. isolationism and a number of other interesting topics. Meanwhile, be sure to stay tuned after the feature interview for our post-game segment when JDI Research founder Juliette Declercq will weigh in on a trade that she and her clients have been on the right side of all year. The epic collapse in Treasury Yields. Patrick will also tell you where and when you can meet Russell Napier for a beer or two while Russell's in Toronto for his economic history class, which we discussed in his recent feature interview.
And I'm Patrick Ceresna. Now, Eric, let's jump right into the S&P 500. It's been pinned in this range. What's going on?
Well, usually when stocks and bonds are telling a different story, bonds end up being right. I definitely want to ask Juliette Declercq about this in the postgame segment because she's been very right about bonds. But as I look at this, I still think that really what I've been saying, which is we're in a vicious bear market rally. I don't know if it's over. I was hoping it was. As far as Charlie McElligot's Ides of March thesis, it's pretty much playing out as expected. The equity markets are struggling in the face of headwinds of seasonality and corporate buybacks being blacked out due to earnings season and so forth. And the CTA model that Charlie's team is so famous for has in fact risen up to the point where now that trigger level for equities to be sold is around 27.95 or so, just a little bit below where the market is. And of course, we need to see a daily close below that number in order to trigger that automated selling. We have seen a couple of tests of those levels intraday, but no daily close down there. Now, keep in mind, even Charlie McElligott has said repeatedly that once these technical headwinds pass, and that should be, it was 1 month, but we're halfway through that month, so another couple weeks here, there's room for a melt-up to begin in mid-April. So we're about halfway through that 1 month risk window that Charlie warned us about. As of this morning, Charlie basically said himself, look, it's really the next week or so is make or break. Either we trigger this Ides of March thesis where we get down to just below the current market, where those sell triggers come into play and everything accelerates to the downside, or we don't. And if we don't, and we get into the middle of April, when those headwinds start to turn to tailwinds, there could be a melt-up. So it's really going to be make or break in the next week or two. And I think there is a very good chance that we get a big move down. But frankly, if we don't hit those trigger levels, there's an equal chance that we get through this and we start moving up. Now, that's probably a perfect situation to trade with the calendared straddle trade, Patrick, that you told us about last week. I know you did a webinar this week. That live webinar is already done. But where can people find the recording if they want to watch it after the fact? Because that certainly is a trading strategy which is perfectly suited to these market conditions.
Yeah, Eric, it was great to see so many of our MacroVoice listeners join me on Wednesday to learn about the calendared straddle strategy. But those of our listeners that missed it and still want to learn about it, all you have to do is go to my website, bigpicturetrading.com, and register for a free trial. And as soon as you do, the recording is in the members section. So let's move on, though, Eric, because I really wanted to talk to you about this dollar. Because once again, the U.S. dollar index is above the 97 handle. And here we go again. Is this thing going to break out? What's your take on this?
Well, and of course the bears are already screaming right shoulder. They think that we're forming a right shoulder and a head and shoulders pattern. I mean, give me a break, Patrick. As you know very well, any uptrend where you have a series of highs and lows, there's a point where it could be developing into a head and shoulders pattern. Sometimes it does, sometimes it doesn't. So it's way too early to say that. What I think we've seen is that even in the face of what was perceived as a massively dovish policy pivot, although I do want to ask ask Juliette Declercq about that in postgame, because I don't think she sees it, just from reading some of her work, necessarily as being as dovish as everyone expects. So stay tuned for postgame this week, folks. In any case, the expectation was, okay, if anything was going to kill the dollar, that was it. And it hasn't done it hardly any damage. We knee-jerked down and knee-jerked right back up again. We're sharply higher today. I think that pretty soon we'll see a break above 97.5, and that's where things should really get going. I think the key to this is to understand it's not just about interest rate differentials. It's about global dollar liquidity. And I think that the arguments that Jeff Snyder has made, we'll have him back on the show in May, by the way. So we do have Jeff Snyder coming back, folks. We've got a bunch of emails requesting him. I think it's really Jeff Snyder's dollar short thesis and dollar squeeze thesis that's in play here. And a lot of people are assuming, hey, look at what's happening with Treasury yields. Surely that's got to be bad for the dollar. Well, if what was driving the dollar was rate differentials, that would be true. I don't think that's the driving force. And I think we're headed higher.
Let's move on to crude oil. Bumping its head around 60. Donald Trump's getting into the mix. What's going on in crude oil?
Well, it's been quite a day, Patrick. I've been saying that I thought the market should have topped by now, but needless to say, bullish inventory surprises last week caught me wrong-footed. Looks like now we're finally seeing that rollover to the downside that I've been predicting. Now, Mr. Trump's tweet certainly helped it Thursday morning, but it had already begun before that. And, it seems like maybe he's getting smarter about his tweets. He's kind of catching the market at times when it's already moving down, so it looks like he's done something really profound. The thing about inventory to understand this week is the Houston ship channel is closed due to a chemical spill. And that means there's been a huge disruption of both import oil not being able to get into Houston and export oil not being able to get out. Now, what that really means is we ought to just discount the EIA inventory numbers this week and say, hey, it's a fuzzy message because we're not dealing, this logistic disruption muddies the waters. We don't really get a clear signal. That's not the way it works in the oil market. Oil traders want to have something to trade on, and they go by that EIA data, whether it's muddied or not. So we got a build on inventory this week of 2.8 million barrels, even though analysts were expecting a drawdown. You'd think that build on inventory after the big draw last week, people would say, oh, maybe, okay, they're bearish, time for the market to finally crash. Well, the thing is, gasoline and distillates, the finished products, were big drawdowns again this week. Gasoline, 2.9 million barrels. Distillates, 2.1 million barrels. U.S. production unchanged at 12.1 million barrels. Cushing, Oklahoma, building 541,000 barrels. So because of the ship channel closure, I think it's entirely plausible that we could have another spike higher. I was actually kind of surprised that we never hit that 60 spot 79 or so 200-day moving average, and that number is certainly sitting up there above the market, waiting to be plucked off. But one of the strongest signs, Patrick, that a new trend is really in play is when the market closes above or below all three of the short-term moving averages, the 5, 8, and 13-day. And today we saw RBOB gasoline close below, and it's been trading well above all of those short-term moving averages. It really took a nosedive. And remember, it took a nosedive on the day that we got what you would think, 2.9 million barrel drawdown. That ought to be bullish. Gasoline had just peaked out. It took a dive. It went all the way down, right through its 21-day moving average, even way down below the short terms into the long-term moving averages. It rebounded, but it never made it back to close above the 13-day moving average. It was right on it about 2 o'clock. There was a push. The bulls were trying to get it to close over because they know that would have been an important technical signal. The bears came in about 2:15, and we closed well below the 13 on RBOB gasoline. Now, WTI crude oil was a slightly different story. That same push that started around 2 o'clock pushed WTI above its 13 to test its 5-day moving average at 59.32. It closed just about on that 5-day and above the 13-day. So at this point, we have a slightly mixed signal. The WTI chart is telling us, hey, maybe one more bounce to another high is coming here because we've completed a price cycle to the downside. WTI also touched its 21-day moving average. at 58.28 this morning before rebounding very vigorously. We're above the 5-day now as we're speaking on Thursday afternoon. Fridays are often up days in crude oil. It's a good chance that we could have maybe one last bounce up tomorrow. But if I look at RBOB gasoline, which has been the leader in this overall move, that's what dragged the crudes up, was the big rally in gasoline. It really looks like it's ending, and it wasn't able to recover its 13-day moving average. So a little bit of a mixed signal there. In general, though, I think that once we get through this Houston ship channel closure issue and that logistic anomaly is out of the system, I think prices are ready to roll over unless we get more inventory surprises, which are bullish. And, of course, anything's possible. Likewise, it's the oil market. Anything can happen if there's a geopolitical upset. But I think finally prices have topped out and are starting to roll over unless we get one of these catalysts to take us higher again.
All right, Eric, I want to move on to gold because gold seemed to, in the last couple of weeks, be edging higher. But what a breakdown today. What's your thinking? What comes next here in gold?
Oh, I'm kicking myself, Patrick. Yesterday afternoon, Tracy Schuchart tweeted a chart saying, hey, look at that ascending wedge starting to break down. And at that point, we were still quite a bit higher than we are today. I was looking at possibly shorting about 13.18 or so as we started to break down from that wedge pattern. And I wish I had, because it was such a big move down today. Now, I know that the gold bugs in the audience want me to tell you that warm and fuzzy, gold bullish story. So I'll tell it to you. Here's how it goes. We had a massive dovish pivot from the Fed. That was what the gold market needed in order to finally let go of that pressure that was building. It rapidly climbed up, barely saw resistance at that key 1350 level. As soon as it broke above that, the buying accelerated, and we're almost at 1400, and it's really looking great. Well, that would be perfectly consistent with the fundamentals. There's just one tiny little problem. That didn't happen. The opposite happened. Even in the face of this dovish move by the Fed, what we're seeing is gold can't even rally under those circumstances. And I really think that what's driving it is the U.S. dollar. The market was thinking, well, this dovish pivot, surely it's got to be dollar bearish and gold bullish. Well, it's not. And I think that we're going to continue to see gold underperform here. Now, I really do believe that gold will be the asset to own when we get to the point where it becomes clear to everyone that the central banks of the world have painted themselves into a corner and are out of options. But we're not there yet. I hope to buy my gold in size at a significant discount to current prices, and I think there's a very good chance that we'll get that significant discount. So, I certainly don't mean to suggest that waiting makes sense unless you're someone like myself who's watching the market every day. I'm not at risk of missing it. If gold breaks above 1350, I'll know it and I'll jump on the trade, and I'll just deal with the fact that I could have bought it lower. At this point, the way I read this chart, it's time to wait and see if we get much lower prices where I'd rather be buying my gold.
Eric, let's move on to that 10-year Treasury yield, because all I have to say is that escalated quickly, didn't it?
Yeah, it sure did. I've been saying for, I think it was months on end, folks, watch this range from 2.60 to 2.80. When we break decisively out of that range in one direction or the other, look for the move to accelerate. Well, even I didn't think it was going to accelerate that quickly. I was looking actually on my Bloomberg screen at the rates this morning, and I'm like, 2.38. No, I want the 10-year rate. Oh, that is the 10-year rate. Holy cow. So, needless to say, we've had a collapse in yields, and I think it's time to acknowledge this is a recession signal. The market is telling us that economic activity does not look good. It doesn't jibe with the stock market. And for that reason, I really want to get Juliette Declercq on our postgame segment, because she's nailed the fixed income side of this call. What I want to ask her is how this jibes with the stock market rally, because I wouldn't expect with this collapse in yields for the stock market to be holding up as well as it is. The MOVE index, which is essentially the VIX for bonds, saw its fourth biggest 5-day move in 30 years. That's a 5.3 standard deviation move. So let's ask Juliette in the postgame segment to give us a little bit of insight.
All right, so this week's featured interview guest is Eric Peters. Now, Eric, why did we invite Eric back as this week's featured interview guest, and why are we bringing Juliette back in the postgame?
Well, Eric Peters has been really prescient in the past. His firm manages a few funds. They've been looking at all of the right trends. I know they're working on launching an inflation-related fund, and certainly it's early in that story, but it's coming, folks. So it's been too long, Patrick, since we've had Eric on the show, and I'm really looking forward to an update. Now, Juliette, we brought in specifically because of the radical action in the Treasury bond curve this week. Juliette and her clients have been right on top of this since the beginning of the year, and they've been on the right side of the trade. So, I have a theory. All of these gurus, sometimes they're in the groove and they're making the calls right. Sometimes they're a little out of touch with the market. Juliette has been nailing it. She's very much in tune with the market on fixed income. So let's ask her in postgame to give us a little bit more perspective.
All right. Well, Eric's interview with One River CIO Eric Peters is coming up as MacroVoices continues right here at macrovoices.com.
And now with this week's special guest, here's hedge fund manager Eric Townsend.
Joining me now is One River CIO Eric Peters. Eric, it's great to have you back on the program. It's been too long. Why don't we start with the big picture on the stock market? We've got a lot of people saying, hey, that Christmas massacre was the buying opportunity of a century because we're headed toward new all-time highs and everything looks great. Quite a few other people, myself included, saying, nah, I think this is a bear market rally that we may find the top is already in and we're headed lower. What do you think in terms of the big picture and where this market is headed?
Hey, Eric, thanks for having me back. It's always nice to chat. I actually think that the equity market peaked last January, actually January of 2018. I know we made a subsequent higher high in September into early October. But I think one of the things that was lacking in this entire bull market was a real period of euphoria. And I think that last January, we had that type of activity in the marketplace. I mean, there was a very powerful up move. It was clearly driven by euphoria over the big tax stimulus. I think that's what we need to see in order to see a market top. I think we're in a market topping phase right now. There certainly are all kinds of different cross currents. Some of the big ones are continued easy monetary policy, but I think that there's some debt and growth dynamics here that are presenting all kinds of headwinds. But the biggest one, when I really step back and kind of look at the market, and I look at what happened last year. Last year was the first year where Treasury bills outperformed virtually everything. That's only happened under Volcker. It happened in the Great Depression at the outset of World War I. So when you look at unusual market activity like that, and I think it's important to kind of ask yourself what's driving it, what's going on, why did such a rare event happen? And the way I like to think about it, and I do this often in our investing, is look back at a point in time and just say, if I knew what was going to unfold over the coming years, what would I expect? And if I look back at, say, 2009, and I could foresee the decade to come, we had this decade where you had an incredibly powerful increase in the financial asset to GDP ratio in the U.S. It's hit an all-time high of 4.4x. So households have more financial assets than they ever have. Corporations borrowed $2.7 trillion during that period of time. Buybacks shrunk the supply of equities by $3.8 trillion. So we had these big kind of financial things happen at the same time that labor's share of the national income declined to record lows. Central banks bailed out basically everyone. There was no real accountability, so people didn't go to jail, with some rare exceptions. So I think there was a big increase in just a sense of injustice, and all of these things helped promote inequality. So corporate profit margins hit all-time highs. And we got to this point where we had this political shift, which we're all aware of. It wasn't just in the U.S., but it was internationally as well. And now we're starting to see this really unusual market behavior, like I just described, with T-bills outperforming everything else. After euphoria or euphoric peak around a big tax cut last year. And those signs, when I add them up together, suggest that something is changing in a big and likely a secular way, where financial assets will undergo a long period of underperformance, having had one of the most spectacular periods of outperformance in financial history.
So that's a very complex picture with a lot of moving parts. As we net that down, what would you say is the biggest risk that exists in today's markets?
I think that setting aside any geopolitical disasters, which can always happen, and I think actually are more likely to happen now than they have been for quite some time. But setting all this aside, I think unambiguously the biggest risk in markets right now is that investors lose faith in the ability of central banks to have the policy tools and or the will and political backing to use those tools to support markets. So I think when you look at what has recently happened here, the Fed was really the only central bank that was genuinely attempting to normalize policy. The Europeans were too frightened. The Japanese are pretty desperate to do it, but haven't been able to move. They've just been stuck for a long time. The U.S. tried to do it, and as we now know, we had this pivot on Jan 4th out of Powell and the Fed. And if you think about the market reaction, it's been, I don't want to say predictable, but it's been understandable. I think people have been relieved that the Fed is not going to continue to push rates higher and have QT on autopilot until we have some type of economic disruption or calamity or whatever it may be. That's what the Fed typically does. So I think there's been a relief rally that, okay, we know that there's a Fed put. It's probably down 20% in the marketplace. Powell's been easy. He's gotten even easier. There's a lot of speculation that the June Fed meeting is will yield even more dovish kind of policy framework. So I think that we've now priced a lot of good news into the market, but when you look at where we got to on a global basis, the Europeans have not been able to normalize policy at all. So they head into the next recession, if that's what's coming next, at negative 40 basis points overnight rates. Japan is negative 10 basis points. And I think that, we've gotten the year off to a good start and asset prices have rallied and a lot of people have covered shorts and there's certainly been performance chasing along the way. But I think if we enter a period where investors see some economic weakness and they lose confidence that the Fed and other central banks have the tools at their disposal to try to support growth and boost inflation, that's when you get a really, really big market shock. Because if people believe that the central banks are still in control, then a recession is something that's bad, but it's not a calamity. It's when we see the next bout of weakness and people worry that there's not a whole lot that we can do. That's when you get, major market event.
I know at One River you guys tend to view markets through a lens not only of price but of volatility. Tell me a little bit about what you're seeing in today's market, certainly equity volatilities, but also, the crazy move that we've seen in this last week or two has been in interest rates. So also what's going on with volatility in rates and foreign exchange?
There's been, just in the last few days, really the last few sessions, there's been a rebound in rates fall and FX fall from really 50-year lows. I mean, we haven't been down to these levels since the 1960s, which is interesting because we see lots of parallels between what's happening in the world today and some of the dynamics at play in the 1960s, which happened to be a very low vol period. It was a period of some political disruptions. It was a period where there was a very large tax cut that was put in place to try to run the economy hotter than it would otherwise be to attract poor rural workers into the industrial centers. So there was kind of this rich-poor divide. There was some experimentation in monetary policy to try to generate a really hot recovery. There were other parallels as well, but it's really interesting that was also a period that had very low volatility. But as we all know, it yielded to a period of the 1970s where we had the highest volatility of the last 100 and so years. So, but at any rate, vol has declined dramatically. It's really kind of collapsed this year. So vol moved higher in Q4, but it was a very muted reaction relative to equity markets. And once equity markets recovered, the vol that had jumped in a muted way then just resumed its trend lower and just really collapsed. So there has been a little bit of a bounce over the last couple of days. It's minor in the big picture of things, but overall vol levels in the marketplace are exceptionally low. They're driven by a variety of things, but I think that the dominant feature is part policy and part market activity. So the policy feature is that I think that the market is, broadly speaking, looked at the Fed having pivoted and said, okay, now that the Fed is pivoted, every major central bank in the world is on hold. They're all tilted toward the easy side or the dovish side, but no one's prepared to cut rates anytime soon here, and no one's going to hike rates. So if the rate markets are going to stay relatively stable, then the foreign exchange market's going to stay relatively stable. And if those stay relatively stable, then we shouldn't get a lot of volatility out of equities. And I think that's been the dominant thinking. What it has done is it has emboldened market participants to go out and add to their short volatility positions. That's been something that's happened over the last few years, but it's clearly increased in size and aggressiveness over the past year.
Let's come back to Treasury yields, because for months and months, the 10-year was stuck between 2.60 and 2.80. It seemed like it never wanted to break out of that range. And boy, when it broke hard. I've been shocked. Not only have we moved all the way down to 2.38 as we're speaking on Wednesday afternoon, but we've also seen an inversion of the yield curve, not just the 2s, 10s, but the 3-month 10-year has inverted. What does all of this mean, and what's coming next?
I guess the honest answer is no one knows exactly what it means. And I think we all bring to the table our biases. I'm really not sure what it means. I break it down as follows, though. It could mean one of three things. So it could mean that we are in this secular stagnation type global environment and that the U.S. is succumbing to that and that central banks are impotent. Because if you believe that we were entering a secular stagnation world and you thought that central banks could do something about it, the central banks have told you that they want to do something about it or that they're easy. And if there were a lot of confidence, then the long end of the yield curve should not decline as it has. The curve should steepen, and that's not what's been happening. So that's a possibility. I think that's the most alarming possibility, quite frankly, because as we talked about, the biggest risk recently, it is that central banks are seen to be impotent. But that's one world. So it's a world of secular stagnation with impotent central banks. Another possibility is that just the yield curve is acting the way it typically does, heading into a period of economic weakness and oftentimes recession. And, first it creeps its way toward flat, and then once it gets around there, then it kind of breaks through in a pretty robust way. It's interesting that credit markets are pretty well behaved, because I think if we really are going to see a recession and it's looming, I would expect credit markets to really suffer, particularly this cycle. And so we haven't seen that dramatically yet, so that's something to keep an eye on. And there's also the possibility it's just a false signal, and that I hear a lot of people talking about the fact that German and Japanese rates have broken through zero again, so they're negative, and that is pushing European and Japanese investors and European investors broadly to move into the U.S. for the enhanced yield. I would suggest that while that's a popular narrative, the flow data to date does not really bear that out. So it sounds like a logical narrative, but there often are logical narratives that just aren't really accurate. So I think it's important to look at the flow data there. It seems like an awfully abrupt move for the Europeans and the Japanese who for the past many, many months, and even quarters in the last couple of years, haven't been piling money into U.S. Treasuries. It seems a little abrupt. All of a sudden, they woke up to the fact that their yields are negative by a few extra basis points, and they're going to pile into Treasuries. Those are the three possibilities. I'm most attuned to the first one, which is the secular stagnation fear with impotent central banks, just because I think that is the scenario whereby markets would move the most. So I think it's important to kind of keep an eye on that one.
I've heard you use a phrase before, which is the next 5 or 10 years are going to look completely different than the last 5 or 10 years. What do you mean by that, and how does it affect investor portfolios?
I think that we're in a period of really quite dramatic change. And you go through these periods in political and economic history, just history generally, where things are relatively stable and stay on a particular trajectory. And even if there's some change around that trajectory, it's relatively stable. And there are these historical periods where there's a lot of change. I think that we're very clearly in one of those. And it's, broadly speaking, been driven by a number of major trends, really kind of, at least from the U.S. perspective, globalization, building of global supply chains that have allowed U.S. corporates to change the nature of the U.S. economy, move a lot of jobs abroad, widen out income inequality, expand profit margins. And all of these various things have led to this period of inequality and injustice that's led to a political change. And we're now seeing the consequences of that political change bear out in policy. And we see voters really looking for kind of almost stunningly new solutions. So MMT would be an example of that. You know, where did that come from? That came out of the blue. People have been talking about it for 15 or 20 years, but all of a sudden it's in the public realm. But, you know, if you look at how quickly the politics in the U.S. change here, just look at, you know, it feels like we dropped out of the Paris Climate Accord, and then within days we're talking about the Green New Deal. I'm exaggerating a little bit, but, you know, we're talking about eviscerating Obamacare, and then now all of a sudden we're talking about Medicare for all. We had this huge tax cut, and now we're talking about 70 to 90% tax rates and abolishing billionaires. We had this massive tax cut that was kind of the size of student debt, and now we're talking about free college tuition. It's just the ability of the public dialogue and political leanings to shift rapidly right now are pretty breathtaking. And I think that all of those things will lead to policies that are intended to address this inequality. And as that happens, it will by definition change the trends that have led us to this environment that's been so good for financial asset prices. So maybe that's a long-winded way of trying to explain it. But I think that there are certain trends that have brought us here. They've been wonderful for financial asset prices. They've led to big inequality. And the political dynamics are shifting now to try to address that inequality. And that will definitionally lead to headwinds for financial asset prices instead of tailwinds, which is what we've been experiencing for a long period of time.
I want to go back to something you mentioned just a moment ago, which is modern monetary theory. Now, although I personally am a little bit skeptical of MMT, I am already convinced that this is going to be the next big thing because of just the groundswell of political support that seems to be growing behind it, both by people who understand it and probably by a larger number who don't. What do you think, first of all, do you think that MMT is a good thing, a bad thing, or indifferent? And regardless of whether you think it's good or bad, how much of a role do you think it's likely to play in public policy going forward?
I think MMT is fascinating because of how it's just surfaced in the public mind. Well, I've heard about MMT for a long time, but I first started hearing people speak about it a few months ago. And so I called up Warren Mossler, who is the pioneer in MMT, and we chatted for quite some time. You know, so I'm kind of going to the source. Warren would say MMT is neither good nor bad. It just is. It's just a way of looking at money. I hate to put words in his mouth, but it's just a way of looking at money. And I think that that's probably the right way to look at it from a purist perspective. But I think on a practical basis, it is going to be maybe a philosophical way of looking at money that is intriguing and that will be embraced by politicians of both parties, depending on who's in power, to justify significant fiscal spending. I think MMT is interesting in that really what it's saying is that a sovereign can print a lot of money if it needs to invest in all kinds of things that society believes are important for it to invest in. And the real constraint is inflation. So if that creation of money to make investments in whatever society wants lead to a lot of inflation, then you have to stop doing that, or you have to trim it, or you have to reverse it even. And so I think that in some ways that's valid, but I think what will happen is politicians will increasingly embrace it because they need something new. Remember, I mentioned that the biggest risk in my mind to markets and almost by extension to economies is that central banks are seen to be impotent. And I think that whether you believe they're impotent or not, they certainly have a lot less firepower with the Fed at 2.25%, relative to when they had rates at 5%. And the ECB is certainly impotent relative to when it had positive interest rates and it's stuck at minus 40 basis points. So the question is what comes next, and I think it will be very substantial fiscal stimulus in the next major recession, and people will use MMT to justify why that's not a bad thing. And I guess time will prove whether they are or are not correct about that.
Let's move on to some geopolitical fronts around the world, starting with China and its relationship to the U.S. It seems like this is just kind of a moving target and a changing picture between the trade negotiations and potential military threats, the denuclearization of the Korean Peninsula, everything else. What's your outlook for how China and the U.S. are going to coexist with one another, and what do you see on the horizon?
This will be the topic that I'm sure we'll all be talking about for the next 10 or 20 years, because China is clearly rising, and we are very clearly shifting from a unipolar world, kind of a post-Berlin Wall unipolar world is now transitioning to a world where the U.S. and China need to figure out how to coexist. The trade dispute or negotiations, however you want to look at them, they're very interesting. They're also very much a sideshow. There's clearly a major issue on intellectual property, and specifically, it's not about the Chinese copying our shoe designs. It's about them copying our airplane and aircraft carrier designs and various high-tech things. I think that the Chinese made a major mistake when they introduced this China 2025 plan, because they laid bare their plans to attempt to dominate the major industries of the future. And, I don't blame them for that. Every country should, I guess, want to do that. But I think that really has fueled this battle. What I think is probably the most interesting thing about the last 2 years in the U.S. politically is that as a nation, at least in my lifetime, and I've been around for a while, we have moved to levels where we have never been more divided on almost any issue. I mean, just name it, politics, healthcare, education, gay rights, name it. We are as divided as we have ever been. The one thing that we've drawn together on and all agree on, and this is, I think, rather frightening, is that whether we're young or old, rich or poor, business people who lead corporations or unions, Democrats, Republicans, African Americans, white people, religious people, atheists, literally break it down any way you want. Everyone at this point really agrees that China is our adversary, or in some cases, even our enemy. And I tell you, 2 years ago, that was not the case. People weren't really paying attention to China. I'd speak with business people and they'd say, yeah, they're stealing our IP. Talk to military people and say, yeah, Obama's not really doing what he needs to do in the South China Sea. But kind of everyone just was keeping quiet about it, and there was no real agreement. Now there is. And, when you have 330 million Americans, or however many we are, they can't agree on almost anything except for that one thing, that's not a great place to be from, when you think about geopolitics. So I think those risks of confrontation are definitely rising. And, let's just hope that no one pulls out the saber-rattling card in the next recession. But, history suggests otherwise.
Another trend that has really got my attention is the rise of populism globally, and probably the Yellow Vest movement in Europe is the most visible aspect of that, although I'm convinced it's a global phenomenon. What do you think is driving it, and where do you think the situation in Europe is headed?
Well, I spent a lot of my career in London and spent a lot of time in Europe, and I think it's just an absolutely wonderful place. I think that I'm probably not going to say anything that's either controversial or new, but the European Union was a construct to prevent future conflict. It was not really a construct to provide for economic dynamism. And it has been inevitable that Europe would face a whole range of challenges. And I think we're just in that period now where it's having to confront the fact that you kind of can't have a currency union without a fiscal union, and you can't really have a fiscal union without a political union. But when the architects of Europe constructed it to try to prevent the atrocities of World War I and World War II from ever repeating, I think they recognized that people in Europe were not even remotely close to being ready to have a political union. let alone a fiscal union. But they recognized that you couldn't get there. You couldn't do all these things without taking some intermediate steps. So I think what they did is they said, listen, let's try to get our economies lined up. Let's have a currency union. And let's just hope that that's going to work so well that it won't be a huge step to do a fiscal union. And then maybe somewhere down the road, maybe 50 years, 30 years, 100 years, we'll end up with a real political union because we will have, there'll be so much mobility between nations that it will all just kind of blend together like the United States. But the problem with that is that it contains a major lie. And that lie is that, look, we're just going to do currency union, but we're not going to try to sneak our way into fiscal or political union. And I think, as the union has become more stressed, what you naturally see is people saying, wait a second, I don't like the fact that you're trying to sneak your way into this. And that's fueled more nationalism in these various countries, call it populism or nationalism. And so we're in that process right now. Hopefully they can figure out a way to get through it. I don't think that they can't get through it, but boy, it's going to be bumpy, and we're in that process right now.
You mentioned off the air another theme that you've looked at, which is the return of U.S. isolationism. What do you mean by U.S. isolationism?
I'll tell you a quick story. So I was driving up to New Hampshire with my kids in the back of the car, and I don't know if you've ever seen the Mount Washington Hotel in Bretton Woods. Yeah, it's a beautiful place, right? It's in the middle of nowhere. It's a little freaky because you're just driving through this vast forest, and then all of a sudden this massive hotel pops up. But I told the kids, I said, guys, take a look. What do you think about that? And what is it? And I said, well, it's a hotel. It's one of the most famous hotels in the world, really, but no one goes there anymore. And they said, well, what's the story? And so I told it, which is in the closing kind of year and a half of World War II. We didn't know when it was going to end, but the war was still going on. We invited all of the Allied nations to that hotel. 44 nations, 730 delegates just secretly arrived there. And we said, we want you to come here and we're going to discuss what the world is going to look like after we win. And everyone knew that without the U.S., they were all going to lose. So they all came there, very proud nations, and they were, really pretty terrified because throughout all of human history, the victor always required, territory, treasure, tribute, you name it. Anyway, they all showed up, and we just sat them down and we said, here's what we're going to do. We're going to architect the world in a very different way. We're going to protect all the trade routes in the world. None of you need a navy. None of you almost really need an army. We're going to guarantee global security and global trade, and we just want everyone to try to figure out how to get rich. And not only that, you can export whatever you want into our country without any material barriers. And if you need to put up some barriers in your country to protect yourselves from our trade, you can do that. And those guys got out of that hotel as fast. They signed that deal and got out of there so fast, just praying that we didn't change our mind. And it was one of the biggest, most bold geopolitical bets in all of human history. And it led to this incredible period of, we're 75 years into it, in this experiment. But we've now gotten to a place, clearly, where, a lot of the world has caught up in really material ways. And the U.S. feels that it can't sustain that structure. And this is not just about Donald Trump. This is, the Americans are like, wait a second, it's not really that fair that we pay, as much for military as the next 15 countries put together. And we pay all this money for NATO. And the trade isn't really fair between the U.S. and various countries. And, some of it is bluster, but there just is an element of the contract needs to be rewritten. But when you consider where the U.S. is in its development, we don't need, in our international trade, we're a pretty closed economy relative to everyone else in the world who built their whole economy around that system. So it doesn't hurt us really nearly as much to kind of step back from the world, save a bunch of money. And I think we're in the process of doing that. And the rest of the world is going to be impacted in a very profound way on the back of this return toward U.S. isolationism. But that's kind of where the U.S. started. This last 75 years was really prompted by having to step into 2 world wars back to back. And we just said, well, let's make sure we don't ever do that again. But that construct has aged, and I think it's in the process of being rewritten.
I think maybe a related subject is we're seeing what to me is an absolutely fascinating trend for more than a decade now. Russia and China have been whining about how they don't like the fact that the U.S. dollar is the world's global reserve currency, and they feel that the U.S. derives too many fringe benefits from that it doesn't deserve. Okay, well, that's Russia and China, and really nobody else was singing that tune. Now suddenly we have the European Union really getting frustrated with, I guess, what I would call the assertiveness of U.S. foreign policy, saying, look, we're going to exercise sanctions against European corporations who do things that we don't like. Now, we're the United States. We don't have any jurisdictional authority to tell any European corporation what to do. But you know what? We're the United States. We're gonna tell them anyway. That seems to be leading to a rather large amount of resentment internationally, to the point that the European Union has now kind of started to take China and Russia's side of this de-dollarization thing and say, you know, we need an alternative to the SWIFT payment system that is not under the thumb of the U.S. government the way SWIFT is. Is that related to this isolationism trend? And where do you think this other trend of the U.S. being so bold in its foreign policy is to, in some cases, alienate and affront some of its longest-standing allies? Where is this all headed?
I think that this is absolutely part of this return toward U.S. isolationism. I think there's no question about it. I think that, you know, our current president is very clearly a disruptor. Lots of people have different ideas about the various things that he is. But one thing he definitely is a disruptor. His approach to international relations is unique, to say the least, and unequivocally he's kind of upset a whole range of allies. And I don't want to say it's all by design, because I really don't think it is all by design. But I think it's part of the general trend that, you know, the U.S. just cares less. You know, when you go into negotiation, you care a lot. You tend to it tends to be obvious. And I think we're going into these renegotiations of everything. You know, whether it's climate, whether it's NATO, whether it's any and every one of our international agreements are being renegotiated. And we're going into it with a bit of the view that we don't care so much because, you know what, we don't. You know, I think it's that simple. I think that we're not. I think that our administration and most of the people in power in the U.S. are less concerned about a new reserve currency popping up than they have ever been, or at least than they have been in the last 15 or 20 years. I shouldn't say ever, because, you know, there was a time where you couldn't even fathom a different reserve currency. But I think it's awfully difficult to imagine a different reserve currency at this point. You know, where are you going to put your money? Are you really going to put your money in China? And everyone who understands China and has money in China is desperate to get their money out. So money's not going into China. The only money going into China will be indexed money, because MSCI, you know, included China in some type of index, and passive flows flow into there. But big private capital is not flowing into China. It's trying to get out. You know, the money's not going to go into Japan. You know, Japan is aging very rapidly. That's not a reserve currency. The UK is too small. And then that leaves Europe. And, you know, we talked about Europe. Europe is going to have a very difficult couple decades ahead. So I think that the Americans are happy to beat people up with the dollar and the dollar payment system. And at the end of the day, we're energy independent, we're food independent, and trade as a proportion of our economy is very small compared to all these other countries. We actually don't care if the dollar goes down a long way. In fact, I think most people in Washington would like to see it go down a long way from where it is right now. So I think in that environment, you know, they're looking at the Europeans or the Russians or the Chinese or the Iranians or the Venezuelans, you know, trying to threaten the U.S. dollar's dominance, and I think that they're completely unconcerned.
Okay, Eric, so we've talked about quite a few different trends here, from what's going on with volatility, maybe coming off of what could be, you know, generational lows in volatility in markets. You've described the ability of central bankers, and maybe they're not having sufficient firepower to be able to fight whatever the next big risk comes in markets. We talked about the yield curve and so forth. MMT clearly on the horizon. I think we both agree about that. China, I mean, this is all all a very complicated picture. Let's bring this all back to investing in portfolios. You guys run money at One River, so you've got to take all of this high-level fuzzy talk and translate it to trades that make money for your clients. What's your strategy and how are you approaching this?
So we have a few different funds and strategies. We, as a firm, we've built our business around trying to identify what we think are the really important and interesting investment opportunities looking out over the next few years. What we really see on the discretionary side is we see a major vol event on the horizon, certainly a normalization in vol, but increasingly I think that for some of the reasons or many of the reasons that we discussed today, we're in a phase change for markets and politics. It is not uncommon as you approach those phase changes to have very low levels of volatility and relative calm in markets. It happened in the 1960s as they approached the 1970s, and I said there were some parallels that we see lining up. We think it will unfold over the next few years, and so we have a long volatility fund to profit significantly from that type of move. We also run a systematic trend strategy that we have run now for 4 or 5 years, one of the best performing trends in the marketplace. And while that overall industry has had a difficult decade, what is also interesting is that the 1960s was the worst performing decade for trend of the past 120 years or so. And it also was followed by the 1970s, which was the best performing period for trend or the best performing decade for trend over the past century. So we think there are great opportunities in some of these unloved strategies. I think generally speaking, the strategies that have performed best over the past 5 or 10 years will face the strongest headwinds and vice versa. The third strategy that we're in the process of bringing to market is a strategy focused on opportunities in inflation. Inflation has been low and very stable for a long period of time. And for some of the reasons that we just discussed, whether it's MMT or Fed impotence leading to vast fiscal spending of one sort or another, we think that inflation will be something that moves around really quite dramatically as we look out over the next 3 to 5 years. So that's what we're doing around this.
Well, I can't thank you enough for a fantastic interview. For people who want to follow your work and learn more about what you do at One River, what's the best way to contact you?
You can send me an email, eric.peters@oneriveram, as in assetmanagement.com.
Okay, well, thanks very much for a fantastic interview. Patrick Ceresna and I will be back as MacroVoices continues right here at MacroVoices.com.
MacroVoices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. You can email questions for the program to mailbag@macrovoices.com, and we'll answer them on the air from time to time in our mailbag segment. We also welcome your suggestions for how we can improve the program. Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, what a great interview with Eric Peters. He really kind of got to the point in terms of some of the big conflicts that are happening in the world. Anyway, joining us for the post game, we have Juliette Declercq from JDI Research. How are you doing, Juliette?
I'm very well, thank you. It's great to hear you, Patrick and Eric.
Well, it's fantastic to have you back on the program, Juliette, because you have been knocking it out of the park with some fantastic calls this year, many of which are very much out of consensus, specifically with regard to fixed income, and it's been working very well. So please walk us through your views and specifically how they differ from consensus.
Hey, Eric and Patrick. So I think where a majority of investors got tripped over in 2019 is the concept of the Fed's dovish pivot. And when I say dovish pivot, I put it like quote unquote, because I actually don't think it is a dovish pivot. So one of my main themes this year is that there hasn't been such thing as a pivot at all, at least not a dovish one. And I'll explain you why very quickly. Firstly, a dovish pivot infers that you become, if only slightly, accommodative. If you turn patient and sort of go on a wait and see mode in restrictive territory, then you may as well wait for Godot because reflation will not happen. Well, this is exactly what I'm arguing. And Trump can't totally blame Powell for that because he's partly responsible. So what we saw in 2018 was a large sugar rush from the tax reform, and I've called it QE4. And what it really did was raising the short-term neutral equilibrium rate, or the infamous R star, to a level that JDR Research estimates around 275%. The issue is that the tax reform was never going to raise long-term growth potential because it doesn't address productivity levels, inequalities, and basically final demand levels. And to be completely fair, this is really a concept that the Fed fully concurred with last year. The issue is they still made the typical economist mistake, which is really extrapolating short-term trends into the future and in a linear manner. And now they're basically busy revising growth forecasts frantically down. And so what we've had last week was a growth forecast for 2019 revised from like 2.5% a few months ago to like just 2.1%. And I actually see trend growth around 1.7%. So that still gives us quite a bit of room for further revisions down. But the elephant in the room really is that you can't revise growth predictions without revising the equilibrium rate because they really joined at the hip. The bottom line is that whilst the Fed believes, and actually wants to make us believe, that it's patiently waiting for reflation to take hold with rates supposedly just below neutral, neutral is actually coming down as well, which means that in the last few months, monetary policy has probably turned restrictive. And my estimate is it's about like 25 to 50 basis points restrictive, just because of the Fed's static approach. And as an aside, and beyond all the controversy on Trump's new Fed appointee, Mr. Moore, I actually agree that rates need to be cut immediately.
So, Juliette, what recommendations are you making?
Well, from our macro analysis, it was really quite easy to infer that upside in 10-year U.S. inflation break-evens would be limited. So we recommended to re-enter shorts at 197. We also continued to look for U.S. front-end inversion and long-end steepening. But really, most importantly, I really think that U.S. Treasuries and generally like global fixed income is still great value here, especially with the global financial repression theme back with a vengeance. So we've been really recommending to focus chiefly on the financial repression theme this year and to accordingly buy fixed income aggressively. The strategy has been really powerful because a large part of the investment community is still very much wrong-footed on that. And that's due to the apparent disconnect between equities and fixed income.
So how do you make sense of the disconnect between those equities and fixed income?
I mean, that's like the $1 million question. And clients have really been scratching their heads trying to make sense of this disconnect between booming equity markets and collapsing yields. The truth is that when you look at aggregates, it can really be misleading. And that's true whether you look at macro aggregates or really equity indices. There is actually unfathomable value in dissecting trends, which hopefully makes my work valuable to clients. Whilst impressive taken at face value, the 2019 risk rally hides really deep divergence between cyclical and defensive sectors. And in fact, I wish I could show you some charts here, but it's really interesting to see that the chief leader in the 2019 so-called cyclical tilt is really like the low vol sector, which tends to be completely correlated with treasuries. So the narrowing equity breadth is hardly a sign of equity health, and it's not really sustainable in the long term. But my word of caution really is that in the medium term, financial repression can trigger really powerful dynamics. So we're not currently recommending anything in equities. We always try to focus on first derivative trades, and e.g. the ones basically most closely linked to our view on macro dynamic. Going forward, I see really two possibilities. One, the Fed will use growing downside inflation risk to justify cuts, and that might even come in tandem with loose financial conditions and blossoming asset bubbles. Or two, the Fed will eventually be pushed to deliver cuts by tightening financial conditions and a break higher in the dollar. But the fact is, in both cases, the belly of the US curve is still excellent value. And the reason we didn't see any downside to that trade is why it's been our main recommendation this year.
Okay, let me see if I've got this straight. The operative question here is, how do you reconcile the equity uptrend with collapsing yields? And you're saying there is no disconnect. We're just discounting the fact that a more dovish Fed will eventually adjust rates to the weakening cyclical outlook. So it's a matter of when, not if. I think I've got that. But Juliette, I cannot let you go before asking about the U.S. dollar. Very near and dear subject to my heart, because last year you were bearish the dollar. So what made you change tack around February?
So for the dollar, really the global return to financial repression for me was a complete game changer. And I've changed my recommendation accordingly. The US is currently the only developed country with substantially positive nominal yields as a sort of a reserve to deactivate and re-rate financial assets. So really, dollar assets will stay irresistible in my mind and continue to outperform until interest rates are slashed. Also, the entrenched belief that the Fed is dovish offers stellar opportunities. For example, after the Fed last week, we have recommended to fade dollar emerging markets downside for like great risk-reward short-term returns, especially because the emerging markets remains quite highly crowded. Basically, an environment where investors misunderstand the market dynamic is my favorite, is my absolute favorite. And that's why I'm happy to share some of the clues tonight with your listener.
Juliette, thank you so much for giving us update. We look forward to having you on the show in the coming month or so as a featured interview guest. Now, Eric, let's move on.
Well, speaking of having people on as feature interview guests, you are going to be interviewing Russell Napier over a couple of beers in Toronto and inviting guests to join you. Tell us what's going on.
Well, listen, when we had Russell on the show earlier this year, he was telling everyone about the program he's running in Toronto on April 8th and 9th. And I know a number of our members have taken advantage of that. And so if you are going to be there and want to join us on the Sunday evening of April the 7th and have a beer with Russell Napier and myself, make sure you reach out to us. Just email me, Patrick, at MacroVoices.com, and I'll give you all of the details as to where we're meeting up. And we look forward to seeing you out there.
And on that note, folks, we need your help promoting MacroVoices, so please tell your friends and colleagues about MacroVoices, forward your research roundup emails, and most importantly, register your free account at MacroVoices.com. Only takes a minute, doesn't cost anything, and we're not going to spam you or sell your email address, we promise. What you will get as your benefit is our free research roundup email, which never contains advertising or marketing. It's just a compendium of links to all of the best content we could find on the internet, including supporting materials from our feature interview guests. Patrick, tell them what they can expect to find in this week's Research Roundup.
This week, you're going to find the transcript for today's interview with Eric Peters as well, a fun article from Kevin Muir called The Wisdom from Carl the Janitor, and as well as a great article from Jeffrey Snyder called Caught Blue, The Big Warning Renewed. So you'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make the program even better. Now, for our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we'll include it in our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter at Erik S. Townsend and myself at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.